Welcome to The Explainer. Okay, so not long ago, markets all around the world just took this sudden, synchronized dive. It left a lot of people scratching their heads. The reason why is actually fascinating. We're going to trace the breadcrumbs from a single decision made in Japan and see how it sent shockwaves that might have even hit your own investments. Let's see how all the dominoes fell.
Right, let's set the scene here. 1 minute, things are chugging along just fine, and then, almost out of nowhere, everything starts to drop. So, what on earth was the trigger? And this is the real puzzle. It wasn't just tech stocks having a bad day or one particular industry. We saw stocks, we saw precious metals like gold, and yeah, even cryptocurrencies all just fall off a cliff together. When everything sells off in lockstep like that, you just know there's some bigger, more powerful force at play.
Now, to figure this out, we've actually got to look away from the usual suspects like Wall Street or London. The real source of this global tremor, the very first domino that tipped over, was all the way in Tokyo.
It all kicked off with this number. Japan announced a huge new economic stimulus package worth about 135 billion US dollars. The goal was simple: give their economy a boost. But this move had a massive, and I mean massive, unintended consequence.
So the market's reaction was immediate and, well, pretty telling. All this new government spending, it made bond investors pretty nervous. They basically started demanding a higher interest rate to loan the Japanese government money. And because of that, those rates, what the pros call bond yields, they just shot up to levels we haven't seen in over a decade. Okay, so why do we care about Japanese interest rates? Well, that sudden spike was a huge deal because it threw a giant wrench into one of the most popular, most widespread investment strategies on the entire planet, something called the yen carry trade. So what in the world is this trade? Well, for years and years, Japan has kept its interest rates super low, like almost zero. And this created this incredible opportunity for big global investors. See, it made it ridiculously cheap to borrow money in Japanese yen. So they would borrow enormous sums of yen, and then they'd go use that money to buy assets in other countries that paid a much higher return. It's a really simple idea when you break it down. Step 1, borrow yen for practically nothing. Step 2, swap it for, say, US dollars. Step 3, buy something like a US government bond that's paying you 5%. That difference, that 4+% gap, that's your profit. And we are not talking about small amounts of money here. This was a multi-trillion-dollar strategy, a giant global river of money, all flowing based on this one simple idea. So how did one little announcement from Japan just completely torpedo the logic of this massively popular trade? This is where things get really interesting. Here it is, the whole reversal in a nutshell. Before the news, borrowing yen was cheap, and the trade was a moneymaker. Simple. But after Japan's announcement, their interest rates spiked. Suddenly, borrowing yen was expensive. The profit margin just vanished, and the trade went from being a sure thing to a really risky losing bet. And that's when the stampede for the exits began. This mass exit has a name. It's called an unwinding. And because the yen carry trade was just so enormous, its unwinding didn't just cause a ripple. No, it sent a shockwave across the entire global financial system. I mean, think about it. To pay back those yen loans that were suddenly costing them a fortune, investors had to sell the very assets they had bought with that money. They had to sell their US stocks, they had to sell their gold, their crypto, literally anything they could get their hands on to raise cash fast. And that selling pressure hit everything, all at once, across the board.
This is what creates something called a risk-off environment. Fear just takes over. The number one priority is no longer about making a profit, it's about stopping a bigger loss. And in this case, the safest place to be wasn't gold or some other asset, it was cash. Specifically, the cash needed to get out of the yen carry trade. So everything else got sold.
So the really crucial thing to get here is that this whole event wasn't just random market noise. It was a perfectly logical, if pretty painful, chain reaction. So here it is, the whole story in 5 simple steps. Japan announces a stimulus plan. That causes their interest rates to rise. This makes a really popular global trade unprofitable, which then forces this massive synchronized sale of assets all around the world, which in turn causes markets everywhere to drop. 5 steps from Tokyo to a global market correction. And look, if there is one big lesson to take away from all of this, it's this. What happens in one country's bond market can directly and powerfully impact the price of, well, almost anything on the complete other side of the planet. Everything is connected. Which, of course, leaves us with a final and pretty fascinating question to think about. We just saw how this one trade, the yen carry trade, was secretly connecting everything. So, what other hidden financial links are out there, quietly tying the global economy together, just waiting for the next unexpected domino to fall?